term of financial statement, profit and loss, balance sheet, and audit report. Financial statement, a formal report of a company's financial performance and position. Includes the statement of profit or loss, balance sheet, statement of financial position, cash flow statement, and statement of changes in equity. Profit and loss account shows income and expenses for a period, revealing whether the company made a profit or a loss. Balance sheet lists the company's assets, liabilities, and shareholders' equity at a specific date. Audit report, an independent auditor's written opinion stating whether the financial statements give a true and fair view and comply with approved accounting standards and the Companies Act 2016. Requirement to appoint auditor for public and private company, Section 267 and Section 271. Section 267, Subsection 1. Every private company must appoint an auditor for each financial year unless exempted. Section 271, Subsection 1. Every public company must also appoint an auditor for each financial year. The auditor must be an approved company auditor under Section 263, approved by the Minister of Finance. Exemption from appointing auditors, Section 267, Subsection 2. Certain private companies may be exempted if they qualify as: first, a dormant company, no accounting transaction during the year, or a zero revenue company with total assets below 300,000 ringgit for the current and previous 2 financial years. Public companies cannot be exempted, they must always appoint auditors. Meaning and objectives of audit. Audit, independent examination of a company's financial statements to express an opinion on whether they are prepared truthfully and in accordance with approved accounting standards. Objectives of audit: to ensure financial statements give a true and fair view, to detect and prevent fraud or error, to increase confidence among shareholders, investors, and the public, to ensure compliance with the Companies Act 2016 and Malaysian financial reporting standards.
The first one is function of an auditor. Auditors perform several important functions in a company. Here have 2 essential functions of an auditor. The first one is to report to members of a company on various matters relating to the preparation of the company financial statement. The second one is to report to the Register of Company (ROC) on any breaches of the Company Act 2016 which were not appropriately dealt with. Auditors also important in ensuring that the interests of shareholders are protected and the management of the company have act reasonable. There are 2 types of audits. The first one is internal audits and the second one is external audit. An internal audit is divided into audit committee and internal auditor. It also consists of internal control mechanisms set up by the company. An external audit. External auditor appointed by the company shareholder, AGM, has extensive duties and obligations toward the shareholder, company, and third parties. Company auditors are not officers of the company. Under Section 264 of Company Act 2016, a person cannot act as or be appointed an auditor if he or she is not an approved company auditor. For example, not registered with the relevant authority. Second, owes more than 25,000 ringgit Malaysia to the company or any its related companies. Third, is connected to the company's officer. For example, is an officer of the company, is a partner, employer, or employee of an officer of the company, is connected through similar relationship that create a conflict of interest. Fourth, keep the company's register. Fifth, is an undischarged bankrupt. And the last one is has been convicted of fraud or dishonesty. Furthermore, the Act differentiates the appointment of auditor for a private company and public company, since the AGM is no longer compulsory for private companies. Here have the person responsible for the appointment of an auditors. The first one is directors. Second, the members. If the director do not appointed, or the ROC on members' written application and failure in appoint by a private company. For private company, they have three sections about the method of appointment. The first section is Section 267 of Company Act 2016, Appointment of Auditors. Every private company must appoint an auditor every financial year. For new companies, the board of directors must appoint the first auditor within 30 days before the end of the period allowed to submit the first financial statement. For later years, if the director don't appoint, then the shareholder must do so at a general meeting. Some small or dormant private companies can be exempt from audit. If the company fails to appoint an auditor, it's an offense under the Act. Second is Section 269 of Company Act 2016, Term of Company of Auditors. The auditors stay in office until 30 days after the financial statements are sent to the shareholder, unless reappointed earlier. If no one else is appointed, the same auditor is automatically reappointed. However, this doesn't apply if the shareholder decides not to reappoint that auditor, or the auditor has already given notice that they do not want to continue. The last one is Section 270 of Company Act 2016. Members can stop deemed reappointment. Shareholders who hold at least 5% of the company's voting right can stop the automatic reappointment. To do this, they must send a written notice to the company saying they do not want the same auditor reappointed. The notice must reach the company at least 30 days before the financial statements are sent out. For public company, here have two sections about the method of appointment. The first section is Section 271 of Company Act 2016, Appointment of Auditors. A public must appoint an auditor for each financial year. Before the first annual general meeting, we can also name it as AGM, the board must appoint an auditor. The board also may appoint an auditor to fill any casual vacancy. At the AGM, the member must appoint an auditor by ordinary resolution. The company who fail to comply commit an offense. The process ensures that a public company always has an auditor appointed either by the board initially or by the members at the AGM, and legal consequence if it fails. The second section is Section 273 of Company Act 2016, Term of Office of Auditors. An auditors hold office according to the terms of the appointment. The auditor may not take office until the previous auditor has ceased. Unless reappointed, the auditor term automatically ends at the conclusion of the next AGM following his appointment. Even for public companies, the auditor term is tied to appointment and AGMs, ensuring regular review and reappointment or replacement.
According to Section 263, Subsection 1 of the Companies Act 2016, only a person who is an approved company auditor can act as an auditor in Malaysia. This approval is granted by the Minister of Finance. If someone performs an audit without approval, it is considered as an offense under the Act. The approval or audit license issued by the Minister is valid for 2 years from the date of issue. it must be renewed every 2 years. To renew, the auditor must continue to show professional competence, ethical standards, and good conduct. Next, under Section 264, subsection 1, some people are not qualified to be appointed as auditors. They include officers of the company, such as director, manager, secretary, or employee. Second, partner or employee of an officer of the company. Third is partner or employee of an employee of the company. Fourth, anyone who owes the company more than 25,000. Fifth, anyone convicted of fraud or dishonesty. And lastly is a bankrupt person. This rule help to prevent conflict of interest and maintain independence. Under Section 264, subsection 1, a body, corporate, or company cannot be appointed as an auditor. Only an individual can be auditor. However, a firm of auditors can be appointed under Section 264, subsection 3, but all partners must qualify and not disqualified. If an auditor later becomes disqualified, their office is automatically vacated and the company must appoint another qualified auditor.
Next, we have powers and duties of an auditor. First, we have duties under the Companies Act 2016. According to Section 266, Subsection 2 and Subsection 3 of Companies Act 2016, first, to examine and form an opinion as to whether the financial statements have been drawn up in accordance with the financial reporting standards of Malaysia and the Companies Act 2016. Next, to examine and form an opinion as to whether the financial statements give a true and fair view of the financial position of the company as of the financial year end, and of its financial performance and cash flow of the year end. Next, to obtain reasonable assurance that the financial statements are free from material misstatement. Next, to report that the accounting and other record and the register required by the Companies Act to be kept by the company have been properly kept in accordance with the provision of the Act. Lastly, to immediately report in writing to the register if he or she has reason to believe that an offence involving fraud and dishonesty is being or has been committed against the company by officials or employees of the company. For these duties and powers under Companies Act, we use case Teo Peng P against one and company. Next, we have duty under the common law. First, duty to shareholders. Auditors are to be appointed by shareholders and report to them directly. This is to ensure that the shareholders receive independent and reliable the true financial position of the company at the time the audit is concluded. We use case He London and General Bank 1965 for this duty. Second one, we have duty to the company. It is fiduciary duty of an auditor to keep the company's information and trade secrets. Further duties of an auditor are as follows. First, duty of care to the company. Second, duty to audit company's financial affairs and to form an opinion required. Next, duty to audit company's financial records generally. Next, duty to report to member of the company of company accounts in the AGM, and duty to use reasonable care and skill while conducting audit and making the report. The third duties are duty of care and skill. First, not to use company's information to gain advantage or benefit from himself or herself. Not to conflict his or her interest with the company's interest. We use Petition against Public Accountant Board 2002 for this duty. The fourth duty is duty to third parties. The court may find the auditor liable to third person as follows. First, the loss or damage suffered by the plaintiff was foreseeable. Next, there was an existing relationship of proximity between the auditor and the plaintiff, and it is reasonable to impose on the auditor a duty of care towards the plaintiff. We use two cases for this duty. First, Kapower Industries PLC against Dickman, and Hadley Bryan against Heller and Partners. The last duty of common law is duty of confidentiality. First, an auditor may disclose confidential information without the company's consent in the following situation. First, for the purpose of discharging duties to the company. Second, in accordance with provision of written law if disclosure is compelled by the process of law or by competent authority, and if disclosure is necessary to protect auditors' interests. Under the Companies Act 2016, no such duty exists because the duties of an auditor are normally a contractual one.
Good morning everyone. Today we will briefly look at the power and duty of a company's auditor as outlined in the law. We can break this down into three main areas based on three important sections of the Companies Act. Number one is right of access to record under Section 266, subsection 4. The auditor must be able to see all the company's book and record at any reasonable time. The main purpose is to let the auditor gather all the necessary fact and figure the sufficient evidence so they can form an independent and professional opinion about the company's financial health. If the management tries to stop the auditor from seeing document, the auditor has the power to report this limitation to the shareholder or the regulator, SSM. Number 2 is right to information and explanation under Section 266, subsection 6. The auditor can ask any official like a director or accountant for information and explanation they need for the audit. This right ensures the auditor can verify the correctness and completeness of the company's account. It's an offense under the Act for an official to refuse or provide incomplete information. 3. Duty to report to members under Section 266, subsection 7. The auditor's most important duty is to report the members who are the shareholder. The report must clearly state whether the financial statement give a true and fair view of the company's situation, comply the approved accounting standard, and are prepared according to the Companies Act 2016. The overall purpose, this report communicates the auditor's professional and independent opinions to the shareholder, usually at the annual general meeting. Let's move on to the final two critical points regarding the auditor's responsibility: to duty, the report offences, and the qualified privilege. 4. Duty to report offences. Under Section 266, subsection 8, if an auditor finds evidence of a serious crime, especially involving fraud or dishonesty during the audit, they cannot keep it secret. The auditor must immediately report to the register SSM. The legal duty is so important that it actually overrides the normal confidentiality an auditor has toward the company. This provision act has a vital protection for shareholder, creditor, and the public against serious corporate fraud or mismanagement. For example, if the director are caught falsifying invoice, the auditor must bypass them and report to SSM. Number 5 is qualified privilege under Section 266, Section 9. The law provides a shield for auditor known as qualified privilege. This protects auditor from being sued for defamation or libel when they make statement in good faith while performing their duties. This protection covers the audit report, statement made to the register, and any other legally required disclosure. The privilege only works if the auditor is honest. It does not protect them if their statements are proven to be dishonest or malicious. The goal is to encourage auditors to report truthfully and fearlessly about the company's financial state without the constant worry of legal retaliation from dissatisfied management. Finally, let's discuss a crucial right that promote transparency and accountability in the company. The auditor right at a general meeting, attends and right to be heard at the general meeting under section 286 subsection 3. This section ensures the auditor has a direct line of communication with the shareholder who are the owner of the company. This company is legally required to send notice of every general meeting to the auditor. The auditor then has right to attend the meeting, be here and speak at the meeting. Their right to speak cover any matter that concern them in their professional capacity as the company auditor. This primarily includes presenting and explaining the audit report, addressing any specific accounting issue, highlighting any irregularities or concern they found during the audit. This right is fundamental because it gives the auditor a direct channel of communication with the shareholder. It ensures the auditor professional findings and opinion are heard by the owner directly, promoting strong transparency and accountability within the corporate structure. This concludes our overview of the key powers and duty of the company auditor under the Companies Act. We have covered their right of access, their duty to report fraud, the illegal protection, and their right to speak directly to the shareholder. That's all for me. Thank you.